about to hear my conversation with Richard Wong, lead portfolio manager and head of Mackenzie's Condo Boutique. Today, we'll talk about why value has outperformed growth thus far in 2026 and if that trend has the legs to last. We'll also talk about opportunities in Canada during a time of heightened tariff risk as well as growing infrastructure spending. And finally, Richard will share his views on what investment ideas he sees right now outside of Canada. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, head of portfolio construction. Today, I'm joined by Richard Wong, lead portfolio manager and head of Mackenzie's Condo Boutique. Richard, welcome to the podcast.
Hello, Rajan. Good to be here.
Richard, 2026 has been quite a year for investors, but what they may not know is thus far through May, value has consistently outperformed growth. Now, that hasn't been in the headlines, which is typically how value investors typically like to keep things. I can't help but notice it's an environment of higher interest rates, real positive rates. It has me thinking the outperformance of value. Is this a blip or cyclical, or are we actually back to normal? What are your thoughts?
An excellent question, Rajan, as always. I remember in the last few years, I've been on this podcast a few times with you, and that question had come up in the past too. And I remember saying quite a few times, it's time for value. And the reason is simply this. For about 13 years, between the financial crisis in 2008-9 to the end of the pandemic, most developed world central banks kept the interest rates close to zero. In a zero rate environment, discounting of cash flows don't work properly. The market values a dollar earned far in the future the same as a dollar earned today. And in that environment, valuation didn't matter and value strategies didn't deliver that well. But if you look back to the decades and decades prior to 2009, 2008, value tend to dominate in terms of performance. I remember when I came into the business in the mid 90s, every single textbook were about why does value always outperform? Now, of course, nobody remembers that now. Fast forward to today, since the end of the pandemic, we've gotten back to norm, like the words you said, back to norm. There is structural inflation and there is structurally positive interest rates. No central banks around the world would want to drive rates back to zero. That was not sustainable, but it did sustain for a long time. So all of a sudden, cost of carry is back to positive territory. A strategy that uses valuation tools and discounting mechanism can deliver results again. And that's what we have done at the Condo Boutique. We've had very good 1, 3, 5 year numbers because we are in a regime where valuation matters.
Very good. Now, Richard, before going into any specific mandates, I wanted to ask you a higher level question. There's a bigger global narrative right now surrounding Canada, our resources, energy security. How much of your conviction is tied to these themes? Are you a thematic investor or do you ignore this as noise and focus on individual businesses?
Well, when it comes to stock picking, we're focusing on stocks, one stock at a time. We're identifying undervalued securities, one stock at a time. But all stocks exist in industries, and all industries exist in an economy, right? We live in a global village. That's an old cliche. So if there are certain things that are happening in the world, then I definitely have to pay attention to it. And it's very hard to pick stocks that will work if it's industry and it is sector, nothing is working. And then you end up picking a cigar butt. So we want to pick stocks that are undervalued, but in industries and economies that are thriving. So that would be the short answer to your question. Those things do matter. So about energy and materials, what's happening really does matter. We are in a world where post COVID, all the countries around the world realizes that hey, When we wanted these surgical gowns, India and China stopped shipping them, right? A lot of goods were tied up, and so people realized we need to duplicate the supply. So that became one layer of additional investments and structural inflation. And now, since the Ukraine and Iran war, which are still going on, both of them, countries and companies around the world realize that they need secure energy supplies. And I think that is a step function up. I don't think we're going to go back to where everybody's going to rely on the same countries and the same suppliers. So security of materials, energy, they're going to become important, and those resources are becoming more and more difficult to develop. So that is a structural, a trend theme, and those stocks are going to benefit from it. So we do own in the condo mandates stocks in the copper area, in oil service, and oil delivery and exploration, and so on.
I'm going to pick up on that theme, Richard, and I'm actually going to use a series of words that you just used. When you're talking about energy, you're talking about energy security. You finished talking about Kundal. I asked you a question about Canada. Let's put it all together. Let's ask a question here about Kundal Canadian security. Now, this is a core mandate for you. When many advisors and investors think about Canada, they might just default to the Canadian banks or Canadian energy producers. That where they should focus, or for you as an investor, are they missing a much broader picture? What's your view here?
Yeah, first of all, the Condo Canadian Security Fund is a unique product. It is a Canadian focused fund and is anchored in Canada, but we have the flexibility of investing up to 49.9% of the fund outside of Canada. So if we find value ideas in these Canadian areas, and there are a lot of leaders in Canadian market. You know, you name some of them. The banks are leaders, global leaders, energy companies. They're global leaders. You know, gold stocks, global leaders. But outside of those areas, we don't find enough interesting, diverse ideas. We find them outside of Canada in the global arena. So back to your question, banks in Canada, you know, they are in the Condo Canadian Security Fund, and banks in Canada have been well run. They are very diverse. They're not just tied to the mortgage market. They have a lot of wealth management businesses. They have investment banking businesses. Most of them are doing quite well. And obviously, Canadian energy. And to a large extent, most of these companies in these segments of the market, they're not expensive. They do have a representation in our portfolio. But outside of that, there are other interesting ideas in Canada that are less well covered, less well followed that we like. And playing to the theme of, you know, resource security, we own a name called Finning for about 2.5, 3 years now. And Finning benefits from something very unique that's happening in the mining segment. You know, it's becoming very, very difficult to develop new mines, you know, environmental regulation, you know, just approvals and the resources and the investments and capex that needs to go into them. So existing companies that operate existing mines have to basically keep looking for more and more ore around the same existing bodies. And to do that, they're having to go from high concentration areas to lower and lower concentrations, having to do more excavating, transporting, intense processing. And that really benefits uh, equipment providers like Caterpillar. And we prefer Finning because it's a much cheaper stock, is the leading dealer globally of Caterpillar equipment, operates in Western Canada and South America, excellent mining geographies. And basically, their equipment is being used more heavily and they do the servicing. They also start to provide power equipment, emergency power equipment, and they have to service those. And the build out of data centers globally requires a lot of additional power, especially when they're before they're hooked up to the grid. So that's a stock that has done well for us and still got upside for us, and that's one of our top 10 positions. I'll give you that example. I can go on, you know.
That's a great example, and I might stay with it for a moment. Finning, great reputation, longstanding, great company, TSX listed. I'm just curious, just from an operations perspective, are they focused on Canadian operations? Is your interest in that name solely focused on that push in Canada for energy security and resources, or are there different layers to the thesis? Why don't you run with this one for a couple minutes?
Well, definitely there is increased capex infrastructure spending in Western Canada, and they definitely benefit from that as the only distributor of Caterpillar equipment in Western Canada, but they're big in Argentina and Chile. And those countries are really focused on developing mining resources, and their governments have become more friendly to the development of those resources. And that's a huge growth area for Finning. So we look at Finning as really a global player, and with their expertise, basically in the dominant mining geographies, globally. I mean, it doesn't get much better than Western Canada and those countries in South America. Obviously, this is a cyclical sector in mining, but the cycle is in full swing, and I think it's got quite a few years to run.
Very good. Now, Richard, I'm speaking with you just removed from a long weekend in Ontario. It was pretty hot. Speaking about heat, you know where else there's heat? It's on the negotiators who are going to be working on USMCA, which opens up for negotiations shortly. So, trade disruption, big concern. Tariffs continue to be top of mind. How do you think about this risk, given there's lots of concerns amongst investors about how this could play out and Canada's reliance on exports to the United States?
Yeah, in the near term, it's going to cause volatility. The headline comes. The supply chain in North America is pretty integrated. Most companies would tell you that try to break that up would take years and years of work and billions and billions of additional investments. So we don't know how the negotiation is going to go. We know, the Trump administration, wants to bring back, jobs to the U.S. They want to secure supply, and I believe that when all the rhetoric is done, ultimately they are going to secure a block that they have security and control over in North America. I think if you see some of the actions that the U.S. administration is doing, what they're doing, blockading Cuba, which is terrible in a humanity kind of crisis there. But what they did in South America, they're securing their control over the North and South America in terms of political security, military wise, and so on. So I believe that they see North America as important to their dominance of the world. And I cannot see, after all the rhetoric is over, why they don't want to continue to see US companies successfully operating a strategic supply chain that includes, Canada and Mexico. And very often, you go back a year ago, almost a year ago now, the Liberation Day when the market was extremely distressed, that actually turned out to be a huge buying opportunity. You can buy good businesses at a crazy bargain prices. So I envision that noise and headline risks created by these negotiations coming up could create that for us too. So remains to be seen, but we'll be kind of sifting through the noise to find great ideas at that time.
Very good, Richard. Now, you were kind enough to already share a great stock idea earlier in our conversation when you talked about finning. I'm curious, when you look at the Canadian market, are there any sectors or even sub-industry groups that at a high level look interesting? Or when it comes to Canada, is it purely in this very moment, May 2026, is it really just about a collection of individual compelling opportunities?
It's a mix of both. I do think that the mining stocks in Canada in general are quite interesting here. They actually pretty good valuation, and again, the importance of the security of supply is important. And copper, for example, we own a couple of copper stocks, Tech Resources and Capstone Mining. They are great operators now and delivering into this cycle. Copper goes into everything, like goes into data centers, goes into the grid, both of which are growing. Copper will do even better if China can somehow reaccelerate their growth. Copper goes into everything in housing, and housing is in doldrums right now. So if housing comes back for some reason, that will be icing on the cake. So that's more of a sector. You pick the most interesting, compelling ideas in a sector like that. But we also find idiosyncratic ideas. For example, last year talking about the Liberation Day, right? When the tariffs were announced, one of the stocks in Canada that we follow for a long time got pummeled. Transforce. Transforce is a leading trucking firm in Canada, actually operates North America wide. And that stock got pummeled for obvious reasons. And we look at that. It's a stock that we've known for a long time. They've done a good job integrating, consolidating a very fragmented system business, becoming the leader, squeezing costs out, building density in their routes. Just an excellent operator. And that stock plummeted. And, we roll up our sleeve and we did a lot of work and we think, you know what? That was a great entry point. And fast forward to today, a year hence, the stock is up a lot from that point, and they are. The whole trade war has basically forced them to even cut more cost. So they're emerging on the other side with even better margins, better density, more integrated systems. So that's a great recovery play. That was really an idiosyncratic situation. There's no other comparables in Canada for stuff like that. There's no trucking sector. It's just a one trucking company that is a really good operator.
Now, Richard, earlier in our conversation, you alluded to the fact that there's a meaningful part of the portfolio that can be held in names listed outside of the outside of Canada. Not to lead your answer there, I said the United States. Opportunities might be in the U.S. I assume they might be elsewhere. What are you seeing outside of Canada?
Well, Canada, the Canadian market really lacks opportunities in some key industries. For example, technology, healthcare. Those are not industries that are really represented in the TSX. So we find those opportunities very much outside of Canada. And in terms of technology, we do have something like 13, 14% exposure to technology. And I remember the last time we talked, we had touched on this. What do we think about AI? And I remember I had said at that time, AI is not a growth investing theme or value investing theme. It's just a new development on planet Earth. And there are value opportunities in that area. And we did find them. Very interesting. I want to touch on this. There's a lot of debates about, oh, is this a bubble? Oh, this is 2000, 2001 again. And why would value investors invest in AI related stocks? Because it's so obvious it's a bubble. I'll present this argument for you. Back in 2000, companies like Nortel and Cisco, they were building fiber in the ground, but nobody's really using them. That was before Netflix. That was before Amazon, right? They're building fiber, waiting for traffic to fill them, and they largely lay empty and underutilized for like a decade afterwards. And they all went bust because it was not sustainable. Here, we've got semiconductors and memory stocks shooting up, and is it speculative or is it fundamental? I'll tell you that. They are making a lot of money and their products are complete sold out this year. They're not laying fiber where nobody's using. They're producing product that are massively in shortage. So this cycle is uniquely very, very different. In my opinion, the stock price moves are driven by strong fundamentals and not speculation, and valuation is well supported. So I would argue that value investors need to look at AI opportunities that are still trading at low valuation. So we tend to find ideas when they're out of favor, when they're lagging, and when they're trading a low valuation. And when we find them in IT related and AI related stocks, we buy them too. And that tends to be outside of Canada. They're predominantly in the US and some in Europe and Japan.
That's a very good example of how you invest outside of Canada. I'm just a little curious when it comes to technology, Richard. All we hear about these days is AI, data centers. You ever come across opportunities outside of those technology names? Everything else seems to feel like old tech. Are there opportunities there?
Well, outside of AI and all that area, the traditional semiconductor sector is of interest because the traditional economy is inflecting upwards. I mean, if you look at the US Purchasing Manager Index and the manufacturing subindex, it's been going flat for the last 3 years until the last 3, 4 months. So the US economy and some parts of the European non residential economy is starting to inflect upwards. And that's beneficial to traditional semiconductors. I'm not talking about AI semiconductors. I'm talking about semiconductors that go into your cars, refrigerators, microwaves, and so on. And so we find opportunities there. We own a couple of stocks that largely sell to the old traditional economy and provide those type of semiconductors. A Japanese company called Renesas and a Swiss company called ST Micro. And they've done quite well year to date, but last year they were really beat up and lagging, and we got an opportunity to buy those stocks, and now they're paying dividends for us. Not literal dividends, but lots of upside returns.
Very good. I'm sure the dividends in some way will follow. That's the thesis. Richard, I noticed that we are at time. As always, a fabulous conversation. Thank you for joining the podcast. Look forward to having you back sometime soon.
Great. Thank you.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.